Okay, my name is Palachi. I know Alan said that my part's the more exciting part, but I don't think so. I truthfully think that what's really exciting is what's in your minds and what you want to develop, and the dreams that you have and the reality that you want to turn them into. That's really the exciting part. It's not the numbers, it's the dollars. It's turning your ideas into reality and into your business. So we'll just start out with, Alan talked about what a budget is, and we'll just talk a little bit about monitoring your budget. A budget is only a useful tool if you actually use it. So what's most important is that once you've created this budget with the various sensitivity analysis, revenue goes up 10%, expenses go up 10%, and vice versa, and just trying to do all your different combinations. What's important is that you continue to compare the budget to your actual results. And so what that means is you need to keep a regular set of accounting books current. So on a monthly basis, you should be running your accounting records to see what your actual results are for the month, comparing them to the budget, and then seeing how you're comparing against budget. So you should set up the budget and financial information so that they mirror each other, so that it's very easy to compare one to the other. Alan talked about creating budgets, but you should be creating a short-term budget, which would mean really one that covers just maybe one fiscal year, so one reporting period, and a long-term budget which may have a lot less detail, but more big picture type of analysis, which could cover from 2 to 5 years. So it's more of a plan. You should be readjusting the budget as necessary, but only due to change in circumstances, perhaps change in the economy, change in interest rates, change in the environment, or your business in general. But ensure you're not constantly changing your budget instead of trying to follow it. So the goal really is to try to achieve your budget. If you're falling short of your budget on a monthly basis, you need to dig deep and see why that's happening. Do I not have enough salespeople? Are my prices not high enough? Are my expenses not under control? And so on. So try to continue to compare always. So consider budget and actual results before making large purchases. Some people say wait 24 hours before making a large purchase. Be very cautious with your cash, and we'll talk about cash flow management later on in the slides. We have clients. Whose revenues range from very small to very, very large. In terms of hundreds of millions of dollars. And regardless of the size, some of them are better at keeping accounting records and better at comparing those actual results to budget because they have the discipline to do it. None of this is exciting stuff. What's exciting, again, is your business. But what's very important is that you see this as a discipline so that you have current records. And I've got clients, again, running very large businesses who really are only measuring their success based on what's in the bank today, but they're not really looking at what do I owe out of what's in the bank, and how am I really performing compared to last year and compared to my budget. And those are very important tools for management. Break-even point. So this is when you're creating your budget. This is something that you'll want to have a good understanding of, and the break-even point really helps you understand your business and the relationship between revenues and expenses. So I'll just kind of run through this slide and then give you a very simple example. I think you'll understand what break-even point is. So it's a point at which sales exactly cover expenses. So the contribution of sales covers all your overhead. All right. Here's a formula: fixed costs over sales minus variable cost per unit. And that will provide you with the number of units you need to sell, or a number of hours you need to sell if you're a consultant, to break even. So simply put, if you charge $100, let me see. Okay, if let's say your monthly overhead cost is $100, and you need to cover at least $100 in order to break even. And if you sell each unit or each hour, or whatever you're selling, and your profit from that sale is $10, you need to sell at least 10 units to earn $100 to cover your overhead. Everything above and beyond that is profit. Okay. If your volume is lower than anticipated, then you need to either raise your price in order to achieve the same $100 gross profit, or you need to reduce your expenses. So you might try to reduce your expenses to $90 because you're only selling 9 units at $10. Okay. Any questions on that?
Everybody understood? Are you sure, guys? Ask questions.
So the idea is to have a really good understanding of what financial commitments you have on a monthly basis. There are costs that are basically your fixed overhead, like your rent or various other office and general type expenses, and those costs are fixed, and on a monthly basis they usually don't change all that much. And then you have your sales items. So if you're selling a product, there's a cost that's related to that sale. So you might buy a t-shirt for $4, sell it for $10, your profit is $6, and hopefully you can sell enough of those $6 profit items to cover your overhead.
I have a question, Andrew. In break-even point, are we saying that the contributions cover the fixed costs?
Correct.
And fixed costs is something which you incur even if you don't operate your company, which means the rentals that you pay, the insurance costs, even if you're not selling anything for some time, you have certain fixed costs. But when you begin to sell something, that sales, every unit has a variable cost, and it has some revenue. So revenue minus variable cost is contribution, and that contribution is got to cover that fixed cost, and that's break-even point.
Correct.
Thanks.
Correct. So those fixed costs, typically they'll be the same on a monthly basis. Things that will fluctuate more related to sales, like we're talking about, the variable costs will be payroll or purchases. Those will fluctuate based on your sales activity. But for the most part, the fixed costs will be your monthly regular expenditures that you incur. Why you need to manage your cash flow. So you want to be aware of shortfalls before they actually happen. Look at regular monthly budget versus your actual to see how you're tracking. And again, always compare to last year as well if you have a year behind you, because it helps you set new targets and see how you're performing. And you have a better chance to stay on budget. You can plan in advance for large purchases or low sales periods. I had a client this summer who came to me and said they realized that they may not have enough money to survive the summer because they're in a seasonal business. They didn't really have an understanding between the cyclical nature of their business and their cash flow. So we helped them. We immediately did a budget for them, with forecast. We looked at their receivables, tried to forecast how soon they can collect those receivables. We tried to slow down the payments of their obligations, so their payables, and try to kind of get them through the 2 or 3 summer months before their business cycle changed and they started generating more revenues and cash flow. How to manage cash flow. There are financial ratios which Lauren and Talia will talk about, which helps you look at your cash flow and how you're tracking and how strong your financial statement is. You calculate those on a monthly basis and compare to ratios that are ideal or that are typical in your industry. You should know when your payments are due. Set reminders for a few days before the due dates. Make sure you have cash available to make those payments. Renegotiate payment terms if they don't really make sense. Try to avoid penalties and so on. Understand the timing of your cash flow, whether it's seasonal or cyclical. So that's kind of part of the issues that one of my clients had. Every service or sale needs an invoice. You need it for tracking. You have to set terms of payment. Don't rely on handshakes. Get everything in writing. And truthfully, a sale isn't a sale until you actually collect the cash. So Alan said cash is king. It's true. You need to really, make sure that your client is creditworthy and has the ability and the desire to pay for your service or your product. Ways to save money. HST is a filing that you'll likely have to do perhaps on even an annual basis or monthly, quarterly. So try to do it as often as possible. If you are a startup and it's likely that you'll have some financial losses at the onset, those will likely result in you getting refunds on your harmonized sales tax, your HST. So you should try to file them monthly, just so you have that cash coming in regularly. Avoid unnecessary penalties and interest. Again, keep track of when your due dates are, set reminders. Clients of all size avoid payments, and then they end up with interest and penalties that they shouldn't really be incurring. So, be cautious of that. Do your own research first. So before spending money on an expert, make sure you do the research and you're getting the best price for the best product or service. Use resources and online tools. Look into government funding. So there are government funding programs available. We have many clients who are currently receiving tax breaks with regard to SR&ED, so that's scientific research and experimentation. Identify needs versus wants. So simple kind of funny example, you need a car, you want a Porsche. Okay, so make sure you're buying what's in the best interest for long term. Not that Porsches don't last a long time, I guess, but be wary of buying in bulk. Costco shoppers, be wary of overspending. Don't buy supplies in month one that will last you for 2 years. So try to preserve your cash flow. Negotiate for the short term. Make sure you're not locked into a set term. It may allow you to avoid paying cancellation fees if you need to change your business plan. That's the presentation. Thank you.
We're going to just line up before it's obviously ask any questions. We're just going to hand out
We've got the budgeting
on the budgeting.
schedules. And if you have any questions, you can either ask me now or during dinner.
See, on the previous slide, you had something about look into government funding and grants and stuff. Like, do you know any examples, like any government funding like that?
There are many different programs available. So those are best to. SR&ED is really one that's available through the Canada Revenue Agency, and that's one that we work with regularly for our clients. Other government funding, you best find those usually by going through the organization or society that's involved in your industry, and they may be able to direct you to any government funding or programs available.
Do you know of any particular one, like just an example, any requirements that's required to be able to get that funding?
Requirements. Well, each funding program has its own separate set of requirements and limits and so on, and size requirements. So the industry in which you're looking to open your business will probably have some more information on that. There should be an association.
Can I help you on that?
Absolutely.
Okay. You should look on the Mars website. You know Mars, some people are saying it. Well, just Google Mars, Toronto. And they have one of the best lists of government funding for companies.
Good to know.
So it's free.
Thank you.
Free is king.
Yeah.
Anything else? Are people starving or any other questions?
Yes. Regarding break-even point, there's two kinds of break-even points, right? When your expenses cover your sales, but now there is no profit at the time, right? So what's the second break-even point?
What's the
second one? I heard there's two kinds of break-even point. The first one covers expenses at what cost, and when you profit or you gain your capital, something like that.
Really, I believe there's one significant break-even point, which
I
would
usually
be
when my expenses equal to my sales, that means I have no profit now, right?
your first part when you're.
When my expenses is covering my costs,
Yeah.
there's no profit now,
Correct.
zero profit
That's
at the
right.
time.
Correct.
So when I gain the profit after that, maybe 3 years, like they told us, that means I cover all my expenses and I gain profit, which is covering my capital as well. But all my expenses from first.
Well, I guess, Alan was talking about different types of expenses. So certain expenses are capital in nature, and they wouldn't be factored into a fixed cost because that capital item, whether it's a piece of equipment, you could really charge it through your expenses on a monthly basis. So if you buy a computer and you expect it to be good for 24 months or for 12 months, or how long, then you would, depreciate that over the period in which it's valuable. But again, that's not really a cash expense, although at the end of that 12 months or 24-month period, you expect to have to replace it, then it is like a cash expense.
Don't lose sight of we're covering cash flows, so everything is based on cash. When you want to get a little more sophisticated, because the financial statements that are provided to the government for filing of tax returns are based on an accrual basis. And as you probably know, the difference makes a big difference. When you're starting out, you need to know how much cash you need, because that's the key thing. But when you're preparing statements in terms of working out break even on a cash flow basis, and you want to include equipment that we know on an accrual basis is going to be amortized, as Ellie said, over possibly 2 years, 3 years, whatever, you're not necessarily comparing apples with apples. So start with the cash flow, and if you need equipment, and you got to spend 10 grand on equipment as an example, that's going to come into your cash flow in terms of breaking even. But really, at the end of the day, as Ellie covered in terms of, you got to start with, okay, what expenses are you going to need regardless? And if, let's say, it's 10,000 a month or 120 for the year, that means you got to sell a certain number of units of whatever you're making. If you're making coffee cups, how much is your gross margin going to be? Well, it's got to be 120,000. And if you know how much you can sell it for and how much it's going to cost, then you know how many units you need to break even, and that's purely on cash, including covering equipment. When you get into the accrual side, of course, which is this topic for another day, and what you prepared to do your tax returns for the government, that's something else. You really need to stick with cash at the beginning, do a cash flow projection, because you need to know where you're going to be short and how much potential financing you'll need. So just take the simple example. I need so much per year, so much per month of expenses. As Lalit mentioned before, certain things that you're going to have to pay rent. Are there staff salaries that you're going to need to pay to run your business, even if it's 1 or 2 people? That's going to be there. And if it's, in my example, 120 a year, that's what you need in terms of your gross margin to break even. And just stick with that. It keeps it simple.
Yeah, so you'll see the handout, it'll give you an idea of what type of expenses you can expect to incur. I think expenses are, not that they're easy to estimate, but at least that's really, you can kind of isolate how much you're going to spend and how much you're going to need. And that's really, when you're creating a budget, your expenses are, if you're realistic, it's probably the one item that you could probably achieve. Once you realize how much you need on a monthly basis to cover those costs, then based on your market study, based on your research and market prices and your competitors, then you should see if the business is even viable, if you can sell enough units at the right dollar amount in order to cover that overhead.
Any other questions? It's supper time.
Do you have any programs for startups like us? Let's say if you're gonna go to your company and ask you professional advice, can you provide us with something special? Because I know it's really expensive to go and get advice from you guys. Right? Well, soon. Sorry.
Okay, so typically we'll meet with clients who need assistance. We'll usually spend about an hour with you and just go through what your needs are and what we can do for you. And based on that 1 hour discussion, we can usually determine what our estimated pricing would be. You know, we're a mid-sized firm. We're about 150 people in our office. If we feel that we can help you, we will. If we feel that maybe another firm can help, then we would help you out as well and make a referral.
And what I have to prepare in terms of just to have a meeting with you?
Well, I think bring in a business plan to the best that you can prepare one. Bring in that type of a budget, and tell us what you're what you're wanting to do. Or then we can talk about really the accounting part and talk a little bit about the tax aspect of what you're planning on doing.
And can you also help me to develop the business structure for the business?
We can, absolutely.
Thanks.
The question was,
The question was, can we assist with, how can we help when you come to us and you need some accounting and tax advice and so on?
Is it right that when it comes to advice on shred stuff, that's not charged up front, or do you?
There, we charge, we base our fee based on hours, our estimated hours of time that we'd spend performing, you know, the service that you need. There are some consulting firms that take a retainer or a contingency fee on shred claims. We don't operate that way. There's two components to a shred claim. One is a financial component, so usually it's fairly straightforward to determine what costs you've spent on research and development. The other component is the technical write-up and the technical aspect. So typically either the business owner-operator will create that technical report, or they'll hire someone to do that for them. Together we can submit that to the Canada Revenue Agency.
Our rule is one of two things. Sometimes the consulting firm that works on a contingency fee basis does everything, and just takes the return that we do for our client and just incorporates it and does it themselves. Others give us the information. They do the report, the technical report, the financial information. They consult with us at times. Again, depends on the organization. And then they give us the information to input as part of the return. Because when you have a corporation, you have a corporate return for your regular operations, then you got to incorporate the shred component, which isn't that complex for us because it becomes second nature. We've done it for a number of years. That isn't hard. It's determining how much of the numbers would, the expenditures would fall into the shred categories, which is what the consultant helps with, and doing the actual technical report. And they have a limitation on how many words it can be and how, you know, how long it can be. It's prescribed by the government.
The shred is a provincial or federal program?
It's a federal program.
Federal.
Yeah, just looking at this very handy tool over here. What's the initial setup cost based on? Is it on an annual basis or the first 3 months, or?
It's really to start the business. I mean, what period it covers, maybe a year, or it's what's a one-time thing to start. You know, perfect example. If you're going to be incorporated, you're going to have to pay a lawyer to incorporate the organization. If there are certain costs that you may not have to incur ever or for a number of years, it'll fall under initial setup costs.
Okay. So your monthly expenses wouldn't fall under this then?
No, it's first time costs.
First time, okay.
You know, I mean, let's say for argument, this is the example of my client. He wanted to construct a building. Well, once he's built that building, that's going to be there for 40 plus years. So he had to determine, okay, what the cost of the building's going to be, what improvements he has to put inside for it, the initial equipment that he would need, any other costs that he would not have to incur further down the line. He needed approval by the government based on the equipment he's going to be repairing, so he had to hire people so he could get approved by the government. Well, that's initial setup costs. After you get past that stage, you've got, okay, what's the ongoing cost? You know, labor, materials, office supplies, staffing, you know, etc. Sorry? Yeah. Upkeep, professional fees.
Okay, thank you. We have our fishbowl here, so please put in your business cards or write in your name, and we'll have a draw later on for some books that we've brought. Okay. Thank you.
Thank you, Alan and Ellie.